Good morning to you both. And Alan, I'll start right there with you. Is the Fed still behind the curve here?
Well, sure. I mean, they know they're behind the curve. They've only gone up 75 basis points, and they know and they've said they have a long way to go. I think this remark about we don't have 75 basis points on our mind is, fairly innocuous. I think the market's made much too much of it. I mean, how many of us really thought they were seriously contemplating 75 on at one meeting? Practically nobody, I think.
Paul, how do you see it, especially given some of the financial conditions tightening that we have seen within the markets, specifically fixed income as of late?
I think that Mr. Powell did a really good job, and I actually applaud him taking the 75 off the table for the simple reason the key issue is where's the terminal rate going to be, and the forward market is already pricing 2.5%. And if he hadn't have taken off the 75, I think that you would have seen a further ratcheting up of the terminal rate, and that may be necessary over time. But right now, I didn't think it was necessary. He didn't either. And I think he wants to consolidate financial conditions where they are. He doesn't want to ease them, but he doesn't want them to get tighter right now in a precipitous fashion. He wants the market to focus on a predictable path towards that terminal rate as priced right now.
I'm glad you brought that up. And Alan, I want to get your thoughts on that. What's neutral? I ask that because even though this was sort of the takeaway, at least yesterday afternoon from the markets, was that despite the biggest rate hike in more than 2 decades, it was sort of taken with dovish overtones, at least in the near term. But longer term, that full rate of neutral estimates seems to be expanding from a Fed perspective. How do we factor that in? Because it still seems pretty hawkish over the long term, potentially.
Yeah. Mark, there's a difference between the way economists think of neutral and the way a lot of people in the markets think of neutral, and it's simple, which is we economists generally think of a neutral real rate, take out the inflation component. Markets tend to, of course, focus on the nominal rate. That's what traders trade on. And it depends what inflation is going to do. If inflation, this idea that the terminal rate might be 2.5-ish or something like that, makes perfect sense if inflation gets down to 2. If inflation doesn't get down to 2, or if it takes a very long time for inflation to get down to 2, that 2.5 peak number that a lot of people have in their heads, I think is probably too low. The peak number I have in my head, but I want to emphasize that it's guesswork about where inflation is going, is more like 3.25, 3.5, something like that. Eventually. They don't need to get there this year by any means.
Paul, it's David. We had Fred Mishkin on yesterday. He was very negative in terms of his expectations of the Fed being able to engineer a soft landing. Said it's not going to be quite as bad as the 70s, but it's going to be really bad. What's your take? What chance do you give him of sort of pulling this thing off?
I think they have a sporting chance, and that is actually a good chance. I think it's cavalier to say they can't achieve it. It's going to take some clever maneuvering and also, quite frankly, a lot of good luck. But I think it's doable. So I think the bearishness about their capacity to actually achieve a soft landing or a softish landing is overstated. And I think Rick is focusing on traditional sort of frameworks, and obviously neutral would be higher, as Alan just commented. But for right now, I think it's prudent to give Mr. Powell and company the benefit of the doubt.